Hello, welcome to the third and final video of our comprehensive problem working from the unadjusted trial balance of the Pastina company through preparing the adjusting journal entries, the adjusted trial balance, their financial statements, and then with this video, we're going to close out all the temporary accounts into retained earnings, and I'll show you how to do that. So in our last video where we left off, we had just finished preparing the financial statements. We prepared the income statement, which led into preparing the statement of shareholders' equity, where the net income for the year is part of the retained earnings roll forward. And then we prepared the balance sheet with all their assets and their liabilities, including the ending balance of the retained earnings, which we got from the statement of shareholders' equity roll forward. So now that we have our financials, we're ready to close out all of our temporary accounts. The temporary accounts are accounts that get closed out every year, and they are all of our income statement accounts, so all of our revenue and income, all of our expenses and losses, and also any dividends that were recorded during the year to a dividend account needs to be reclassed into the retained earnings account. If you're not familiar with the temporary accounts and the closing process, please look through your chapter. There's a section on it, how to do it. Or again, you can always go back to your financial accounting textbook to go through this. This entire video is meant to be a review of all this information that you learn in financial accounting. It's not meant to teach you from scratch. So if you need a little refresher, please go back to your prior textbooks or the current textbook, chapter 2. So what we do for the closing entries is after we prepare the financial statements, we're going to look at all of our income statement accounts and book the opposite of whatever balance they are and book it into retained earnings. So what does that mean? Let's look at sales revenue. Let's look at our adjusted trial balance. I'm just going to move the tab right here because that's where we're going to look at. And I'm just going to let's just put kind of a highlight here so we know we're just looking at row 23 through row 34. So everything above row 23 here, these are all balance sheet accounts. These accounts get rolled forward year after year and do not get closed out. Those are considered to be permanent accounts, so we don't touch those. Let's start with sales revenue, and then I'll get to the dividends one at the end. So sales revenue, here we have a debit credit, so column D is the credit. So if we have a credit balance on our trial balance for 146, the way we close it out is we're going to debit that amount into sales revenue. So I'm going to debit my sales revenue. And same thing, I look at to see if I have other income or revenue items, and I do. I have interest revenue for one, and it's a credit balance on my trial balance. So I'm going to do the opposite. I'm going to debit it. In my closing entry, and I'm going to do that. So now I have a debit to sales revenue and a debit to interest revenue, and then my credit goes to retained earnings. So this is how I post all the income statement accounts into my retained earnings, so that next year on January 1, 2028, my retained earnings include all of my 2027 income and expense items in the balance that we're starting out with. So that's for the revenue accounts. I just want to go through also the T accounts. Let's see what happens to the T accounts. I have rolled forward only our income statement T accounts because these are the only things we're going to be impacting except for the retained earnings. And we started with $146,000 in our adjusted T accounts. And now we're posting a debit to see how I labeled the closing entry so that our final balance in our sales revenue account shows 0. Okay, let's go to now the expense items. So if I look at my adjusted trial balance, right, and I look at my cost of goods sold and my salaries expense, all my expense items listed right here, they're all under the debit column. So on my adjusted trial balance, they're debits. So what I need to do to close them out is I need to credit those accounts. So I'm going to go right here, and I have listed all these accounts in the same order. So I'm going to go, we're going to credit the cost of goods sold for $70,000. And you see, I have it as a formula here that the retained earnings is going to be whatever we credit for the expense accounts, the debit is going to go into retained earnings. So I'm just going to carry this formula through right here. And so now I've credited all my expense accounts and I've debited my retained earnings. So my journal entry balances. And if we go into our T accounts, here's my cost of goods T account. The last time I looked at my cost of goods sold balance, it was $70,000. And now I have a credit for my closing entry number 1. I've labeled these as, this is my closing entry and this is closing entry number 1. It's just the label I used, but for $70,000. And you can see the same thing here in the salaries expense. We had a debit balance going into here of $20,400, and now I'm crediting it for that amount. So my final income statement amounts are 0. So you can see when we do for all of these, all my expense amounts are 0. Finally, the last closing entry I'm going to post is to close out the dividends account into retained earnings. Let's go back to our adjusted trial balance. And right here we have dividends. So during the year, we had declared dividends for $4,000. And when we did that, our entry was debit dividends, $4,000, credit cash if they paid it out, or credit dividends payable if they had not credited out. But we don't have a dividends payable account on our balance sheet, which means that they paid it out. So which means it was a credit to cash. Okay, so now we have a debit balance in our dividend account, which is also a temporary account, okay, but it's not an account that goes on your income statement, okay? So that's just something, it's really important to know that your dividends account is not a dividend expense. It's just a placeholder, if you will, until we close it out into retained earnings. So the dividend account has a debit balance of $4,000, which means to close it out, I'm going to credit the dividends for $4,000. So I'm going to go right here and just do a formula. And then the other side of that formula means I'm going to debit retained earnings for $4,000. So now back to my T accounts, I'm going to scroll down. Here's my dividends T account. Again, it's not an income statement item, but it is an account. So we're going to have a T account for it. And here you can see the final year-end balance is 0 after I post my final closing entry. And then let's see what happens to retained earnings. I started out with $28,500. I'm going to go back to the adjusted trial balance. And this is what I had in my retained earnings, $28,500, and it was a credit balance. So I'm going to have it on my right side. And then for each of these closing entries, I had to post it to my retained earnings. This $147,333 credit comes from my entry closing out my revenue accounts. Here's my credit to retained earnings for that amount. Closing out my expense account, I debited retained earnings for $123,200. So I'm going to go down here, and here's my $123,200 debiting the retained earnings on the T account. And then we have the same thing for the dividends where we had to debit the retained earnings for the $4,000. So then my ending retained earnings ends up being $48,633. Now we're ready to prepare our post-closing trial balance. And here's our trial balance with, you'll see I put in all the income statement accounts, the balance sheet and income statement accounts, but you'll see what happens to those. So the post-closing trial balance just comes from the adjusted trial balance. All the balance sheet accounts come from the adjusted trial balance. So here's my cash. I'm going to do a plus. I'm going to go to my adjusted trial balance. Here's my cash balance of $30,000. I'm going to do the same thing with accounts receivable, which is 40,000. And I'm just going to do that for all of my assets. So let me just go right through here. And then for all my liabilities, including my accumulated depreciation, which is a contra asset, so its normal balance is a credit balance, I'm going to look at my adjusted trial balance. So I'm going to just look at here. Let's look at my accumulated depreciation. It's 40,000, and then I'm just going to bring down all those other accounts, okay, up until the common stock number. So basically, everything above this yellow highlight on this adjusted trial balance is going to be exactly the same on this adjusted trial balance and the post-closing trial balance, because we didn't touch any of the balance sheet accounts except for retained earnings, okay? So now, when I look at my retained earnings, I have a new, you're not going to go into the adjusted trial balance because this 28,500 does not have all the income statement items and the dividend items flowing into it. We have to look at our ending retained earnings balance from our T account right here, which is a credit balance of $48,633. So we put in the credit balance. And I say credit because it's important to be careful with your debits and credits, because the retained earnings account can have a debit balance. If a company is constantly at a loss, then it's very possible for the retained earnings to have a debit balance. So just be careful. Now, let's look at the dividends account. So here, B91, oh, that doesn't work. Okay, let's go to dividends. Let's look at our T account. Here's our T account, it's 0. All of our income statement, let's look at our sales revenue. Let's go to our T account because we're going to pick up our final amount, and it's 0. You'll see for all the income statement items, the final amount is 0 because now we have transferred all those income and expense items into the retained earnings balance. So we're going to have zeros for everything. We're not going to have anything in these accounts when we start the new year, the following year, which is 2028. So now for 2028, when we start booking things to our revenue and our expense accounts, it'll be just for that year. It doesn't intermingle the prior year income and expense amounts. Okay, that's why they're called temporary accounts, because they get closed out at the end of every year into the retained earnings. And this is how you have your post-closing trial balance. These balances, these balance sheet accounts, are going to be your beginning balances for the following year, and then any transactions that get posted in the following year will affect these accounts. And then the income statement is for specifically just for that year. And one final note, we always want our debits and credits to balance. So if this was not, did not equal each other, then there's a mistake and you'd have to go in and dig through it to find out where it is.